Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at DraftKings.
If you find our talks useful, please consider subscribe, like, and comment underneath. And make sure to check out the special 14-day trial link below in the description for StockOracle.
Right, and just a quick reminder for you listening, that is an affiliate link, so the channel may earn a commission at no extra cost to you.
Exactly. StockOracle is an AI-aided stock research platform. It's, not financial advice or trading signal service or real-time market data.
Yeah, and keep in mind, AI insights and valuation estimates can be incomplete or wrong, so always verify the important facts yourself.
Totally. Plus, we're just talking about the upside and downside here today. We never tell you to buy, sell, or hold.
That is super important. So jumping into DraftKings, imagine like you spend a decade building this massive, impenetrable fortress.
Okay, I'm picturing it.
You dig this deep moat, you build up these stone walls, and you navigate this endless, agonizing labyrinth of local zoning laws. You spend literally billions just securing the permits to even exist.
Right, it sounds exhausting just thinking about it.
It is. And then right when you lay the last brick, you look out over the walls and see a bunch of people setting up pop-up tents right on your front lawn.
Oh, wow. Just doing exactly what you do, but completely ignoring all the rules you just spent a decade following.
Exactly, and making an absolute fortune doing it, completely unchecked by the authorities.
I mean, you'd be furious. It would be infuriating. But then, and this is the wild part of this scenario, the exact same strict regulators who made your life a total nightmare suddenly ride out and start arresting all the people in the tents.
Right, so in an instant, those suffocating rules aren't your biggest headache anymore?
No. They become your absolute biggest competitive advantage.
It is basically the ultimate plot twist in corporate strategy.
And that is exactly where DraftKings is sitting right now, in August of 2026. For you listening, this is a masterclass in wealth-building context and market dynamics.
Yeah, you've got this hard-fought profitability colliding with brutal regulatory wars.
Plus some wild stock fluctuations and very interesting moves by the so-called smart money.
And it's a pivotal moment, right? Because they have a highly anticipated earnings report dropping in just a few days on August 6th.
So our mission today is to cut through the noise. We're looking at live financial data, recent company filings, and fresh market sentiment to figure out what is actually happening under the hood. No fluff.
Right. And to understand the stock, we really first have to look at the underlying business, the engine itself.
Yeah, because for years, the narrative around digital sportsbooks was that they were basically charities for gamblers.
Oh, totally. Just bleeding cash.
Exactly, handing out free bets to anyone with a pulse just to acquire market share. But looking at the data, it seems they just crossed a massive threshold.
They did. They have officially transitioned from a cash-burning growth story into actual profitability.
Okay, let's unpack the fundamentals on that, because I want to make sure I'm reading this right. They have a trailing 12-month revenue growth of 25.8% year over year.
Which is aggressive top-line expansion.
It is. But the bottom line is what really caught my eye. They posted a positive trailing 12-month earnings per share of $0.097.
So basically 9 cents a share.
Right. With a net margin of 0.93%. I mean, on the surface, making less than a penny of profit on every dollar seems tiny. Is that actually something to celebrate?
In this specific industry, crossing that zero line is everything. You really have to remember the context here.
Because they were intentionally running at a loss before.
Exactly. This wasn't a company struggling to make a profit because of bad product. They were running at a massive loss to win a land grab.
Ah, and now the land is mostly conquered.
Right. So they are flipping the switch. And what's fascinating is the why behind the transition. It's not just growth for the sake of growth anymore. Their gross margins are now sitting at a very healthy 41.79%.
Which means they're keeping a lot more of the money moving through the platform. But how did they do that without losing users?
It comes down to two major operational shifts. First, they improved what the industry calls structural hold.
Basically the house edge, right?
Yep, simply the house edge. It is the percentage of total wagers the company actually keeps. After all, winning bets are paid out.
So they are pushing more complex bets to the users.
Exactly. By optimizing odds and creating more complex parlay bets that are harder for the user to win, they increase that structural hold.
Wow. Okay. So they are just getting much better at being in the casino.
They really are. The math is tilting further in their favor, and the second shift is promotional discipline. Think back to a couple years ago.
Oh, man. You couldn't watch a single football game without seeing a DraftKings ad offering hundreds of dollars in free bets.
Just for downloading the app, right?
I definitely took advantage of a few of those. I mean, it felt like they were just setting money on fire to get my email address.
And they basically were. But it was a necessary phase to freeze out smaller competitors. Now they've dialed that fire hose way back.
So they are focusing on keeping the profitable users they already have.
Exactly, instead of blindly buying new ones. Because of that discipline, the company is now generating positive free cash flow.
Which means the money left over after paying all operating expenses and maintaining the core business, right?
Spot on. It's the cash left after keeping the lights on. And having positive free cash flow is a total game changer.
Because they can fund their own growth now.
Right, they can build out data analytics or launch in new geographic areas without going to the bank for expensive debt. They are totally self-sustaining.
Okay, that sounds like a fantastic engine. But I have to play the skeptic here. I'm looking at the balance sheet metrics, and one number really jumps out as a red flag.
Let me guess, the price-to-book ratio.
Yes, it is sitting at 19.25.
It's certainly a number that makes traditional value investors pause.
I mean, it's massive. For you listening, the price-to-book ratio essentially compares what the market says the company is worth versus the actual physical assets if they liquidated everything tomorrow.
Right, the bricks and wood.
Exactly. It's like looking at a house where the bricks and wood and land cost $100,000, but the seller's demanding $1.9 million. So I have to push back. Isn't the market paying an absolutely insane premium here?
It's a completely fair question, but you really have to adjust how you define bricks and wood in a modern digital economy.
Because they don't own massive casino resorts on the Vegas Strip.
Exactly. They don't have thousands of hotel rooms or physical slot machines anchoring a balance sheet. You are looking at an asset-light digital business.
So that 19.25 ratio isn't paying for physical real estate.
No, you're paying for their proprietary technology stack, their data ecosystem, and crucially, that regulatory licensing moat we talked about earlier.
Fortress walls.
Yes, the walls. Operating under strict state-by-state regulatory frameworks is grueling. Every state has a different gaming commission, different tax rates, different compliance standards.
And different server requirements, I imagine.
Oh, absolutely. And DraftKings already spent the billions of dollars and years of legal wrangling to navigate that maze across North America.
Which creates an incredibly high barrier to entry. I mean, if we wanted to start a competing sportsbook tomorrow, the legal costs alone would bankrupt us.
Long before you ever hired your first software engineer, that legally regulated status is their most valuable asset, even if it doesn't show up on a traditional accounting ledger like a skyscraper would.
Okay, so the business is generating free cash flow, and they are protected by this massive regulatory moat. But why does the stock chart look like a disaster zone?
Yeah, the technicals definitely tell a pretty contradictory story right now.
The price action is rough. It's currently trading around $23.48. That is miles below its 52-week high of 48.78.
A brutal year-to-date return of negative 31.86%.
And even with a recent little 6% rally, the stock is still trapped below its key moving averages. So if revenues were up nearly 26% and they just hit profitability, what broke?
To understand the drop, you really have to look at market psychology. When a company transitions from hypergrowth to profitable, the investor base changes.
Oh, so the growth investors get bored and sell.
Exactly. They loved the explosive revenue numbers, but now traditional value investors look at that tiny 9-cent profit and think it's not enough earnings yet to jump in.
So they are caught in the middle. Combine that with a broader market rotation away from tech stocks earlier this year and growing fears about new competitors, and you get a massive sell-off.
Right. It's basically a valuation paradox.
It's like a mile-long freight train. Management hit the brakes on cash burn and started the engine toward profit, but the stock price is the miles of heavy train cars behind it.
I love that visualization. It takes time and friction to slow down negative momentum. The fundamentals turned around before the stock price could catch up.
And that lag creates the paradox, because if we look at the PE ratio, the price to earnings, it is sky high at 198.64.
Almost 200.
Yeah, which is usually bubble territory. Paying $200 for every $1 of profit makes it look wildly overvalued.
It does, but it's a mathematical artifact of where they are in their life cycle. They just barely cross the line into profitability.
So the earnings are technically positive but microscopic, that 9 cents a share.
Exactly. The PE ratio is just stock price divided by earnings. When you divide by a tiny fraction of a dollar, the ratio mathematically explodes.
So it doesn't mean they are a bubble, just that they are in the first inning of making money.
Right, which makes the PE ratio basically useless right now. Savvy analysts look at the price-to-sales ratio, the PS, instead.
And that is sitting at just 1.85. For you listening, the PS ratio means you pay $1.85 for every dollar of actual revenue brought in, regardless of profit.
Which is exceptionally cheap for a high-growth software and digital gaming entity growing revenue at 26% a year.
I mean, many tech companies with similar growth trade at 5 or 10 times their sales.
Exactly. This metric suggests the actual revenue-generating power is significantly undervalued by the market.
So if you are looking for a turnaround setup, what are the technicals saying? Is the freight train finally stopping?
There are some very specific technical breadcrumbs here. The short-term 13-week return is actually positive at 1.47%.
And the trading volume data shows activity has slowed down. It's running at about 0.88 times the 3-month average.
Right, fewer shares changing hands. When a stock falls heavily, then volume dries up while price stabilizes. Technical analysts call it a basing pattern.
Meaning the panic selling is exhausted. Everyone who wanted to dump the stock has done it.
Yes, the stock is finding a hard floor.
But a floor isn't a bounce. It needs a spark, a catalyst, to move upward.
And this brings us back to the tents on the lawn from our earlier analogy, the catalysts and the regulatory wars.
The bear case. The biggest threat hasn't been regulated rivals like FanDuel or BetMGM, right?
No, it's been the absolute explosion of unregulated prediction markets. Platforms like Polymarket and specifically Kalshi.
Which aren't just sports books. They let you bet on almost anything. Will the Fed cut rates? Who wins an election? Will a pop star get married?
And people are swarming to them. Kalshi alone handled $33 billion in monthly volume this past June.
$33 billion in a single month. That is staggering liquidity.
And that was the fear driving DraftKings stock down. Wall Street saw that volume being directly siphoned away from regulated platforms.
Because why bet on a football game when you can bet on the entire global economy on a sleek app?
Exactly. It was an existential threat.
But here's where it gets really interesting, that plot twist we mentioned. DraftKings' biggest threat just became their absolute biggest catalyst.
Right, because state regulators, specifically in New York, just stepped in with a sledgehammer.
They are actively suing Kalshi, claiming they operate an illegal, unregulated gambling ring.
And it's not a polite cease and desist letter. They are seeking $36 billion in damages and demanding a total shutdown.
Which just completely validates DraftKings' costly business model. All that money spent navigating compliance is finally paying off.
Yes, the regulators are doing DraftKings' dirty work. By trying to wipe out gray market competition, New York is artificially protecting DraftKings' market share.
And there is some wild speculative flavor out there about this lawsuit.
Oh, there is. You have to treat rumors with caution, but there's active chatter that this crackdown might accelerate DraftKings acquiring distressed prediction market assets.
Wait, meaning they would buy the very companies getting sued?
Exactly. If these unregulated platforms get crippled by massive legal fees, their valuations plummet. DraftKings could swoop in and buy up their proprietary tech at a huge discount.
That is ruthless. You let regulators demolish your competitor's castle, then buy the rubble for pennies on the dollar.
And you just fold that tech right into your own legal regulated framework.
Wow. So with this regulatory moat being defended so aggressively, how is Wall Street reacting ahead of the August 6th earnings? Let's check the sentiment.
Well, quantitative sentiment scoring shows the mood shifting from bearish to cautiously bullish. And the loudest signal is coming from Michael Burry,
The famous investor from The Big Short. He's been actively accumulating DraftKings shares.
Yes, the filings indicate he views it as a de-risked value stock, likely looking at that exact same cheap price-to-sales ratio we discussed.
I hear that, but I have to play devil's advocate. There is a glaring contradiction in the numbers.
The insider selling.
Yes. If Michael Burry is buying, why does the data show massive net insider selling over the last 90 days? Negative 2.1 million shares sold by insiders.
With 51 separate sell transactions compared to only 27 buys.
Exactly. That is a heavy tilt towards selling. Are they fleeing a sinking ship?
It's a great catch, and seeing that always triggers alarm bells for retail investors. However, you have to understand how corporate compensation works in tech.
A lot of it is in cash.
Right. It's restricted stock units, or RSUs. When those vest and become theirs, executives face immediate massive tax bills from the IRS.
So they are taxed on the stock value as if it were regular income.
Precisely. So the vast majority of the time, executives have pre-scheduled automated plans to sell a chunk of shares just to cover taxes.
Or it's just simple portfolio diversification.
Exactly. Any financial advisor will tell you not to keep 90% of your net worth tied up in your employer's stock. It doesn't mean they think the company will fail.
Okay, so it's not always a panic sell.
No, and to counter any lingering anxiety about that, look at the options market. Intelligence feeds are picking up highly unusual options activity.
Large institutional traders positioning for a major upward move around the earnings report.
Yes, placing big bets that the stock is going to pop.
Right.
And it ties perfectly into their operational momentum. While Kalshi is bogged down in court, DraftKings is quietly expanding.
Like launching their sportsbook and online casino in Alberta, Canada with Golden Nugget.
Right. They are keeping their heads down, expanding legally, and letting the options market price in the upside.
All right, let's bring all these threads together for the final verdict. We've looked at the underlying engine, the battered stock chart, the lawsuits, and where the smart money is flowing.
Based on all of this, DraftKings earns a 7 out of 10 bullish score heading into this earnings report.
It's a very interesting setup to watch. Just to summarize the upside and downside. On the upside, you have a dominant, legally licensed operator that achieved profitability with nearly 26% revenue growth.
Right, and the New York lawsuit against Kalshi potentially removes a massive $36 billion competitive threat.
Proving the decade-long regulatory strategy was actually brilliant. Plus, you have a remarkably cheap PS ratio of 1.85 and Michael Burry buying in. The downside risk is obviously if those earnings margins disappoint or if the broader tech sell-off resumes. But the major catalyst is seeing if they capture the market share fleeing from those unregulated platforms.
It will all come down to the margins they report on August 6th. But I want to leave you with a final thought on the long-term view, looking past just this one earnings call.
Let's hear it.
We discussed Kalshi handling $33 billion in a single month. Regardless of legality, that proves there is a massive, insatiable consumer appetite for betting on non-sports events.
People want to trade on politics, pop culture, economic outcomes.
Right. And right now, DraftKings' superpower is their legal moat in the sports world. So what happens when they leverage that moat to expand beyond sports?
Oh, man.
What happens when they decide to dominate the broader prediction market space themselves?
If they work with regulators to legally offer the exact same wagers Kalshi's getting sued over, they aren't just a sports betting company anymore.
Exactly. They become the de facto financial exchange for the entire cultural zeitgeist.
And that is exactly why you build the fortress in the first place. You suffer through the permits, dig the moat, take the hits on your stock price, and let the regulators chase everyone else off the lawn.
Because once the dust settles, you are the only one left standing with a license to print money on almost anything.
Keep your eyes on that August 6th earnings report. It's going to be a fascinating ride. And if you find our talks useful, please consider subscribe, like, and comment underneath.
And don't forget to check out the special 14-day trial link below in the description for StockOracle to get more AI insights on setups exactly like this one.
Absolutely. See you next time on Smart Wealth with Joshua.